Hey traders, this is Blake Morrow, and with me today I have the one and only Andreas Steno. Good to see you.
Good to see you, Blake. Thanks for having me.
You know, it's wonderful to have you back. It's been a long time since I've done an interview with you on Trader Summit. I want to say it was at the beginning of the year, and I always listen to all of your work. I love to listen to your analysis and your views in the markets, but I'm excited to have you share those views, or at least some of them, with the Trader Summit community. So it's really nice to have you here again.
Yeah, I look forward to it.
So let me ask you this. Let's just kick this off by addressing the big elephant in the room right now. Everybody, you know, the general consensus call right now is a recession. We're seeing it in commodities. We're seeing this, you know, really big move, and doesn't matter really what commodity you're looking at. The markets have priced in possible rate cuts going into next year. So what are your views, big picture views, as far as a recession, whether you're talking US, global, and what do we do with this slide that you're seeing in the commodities market? Is it sustainable?
Well, I already think we are amidst the recession, to be honest. First quarter results are already out, right?
Yeah.
We know that we had a negative print quarter on quarter in Q1. The Atlanta Fed model points to a negative print quarter on quarter this quarter as well. And I frankly think that we will have negative quarters also in Q3 and Q4. So that counts as a recession in my book.
Yeah.
If you look at the commodity space, I basically think that copper is the best early indicator of what the business cycle is doing. There is a reason why everybody is calling it Dr. Copper. Yeah. I mean, look at the price action over the past month or so. It's a clear bear market, right? I think it's linked to the growth slowdown that we see in the US, in Europe in particular, but also the recession that is already there in China. So it's really tricky to find a bright spot when it comes to the global economy right now, because I frankly don't think that there are any out there right now.
Oh, that's, you know, it's scary to think in that term, but we have seen mortgage rates just rally substantially, you know, on the back of what the Fed and other central banks have been doing. But do you think that the Fed is going to, I know this is probably a topic of conversation you have all the time with other guests that you interview, but what do you think about a Fed pivot? I mean, is that even possible at this stage in the game?
Well, the tricky thing here is that we don't have a lot of empirical evidence of what the Fed will do with inflation running clearly above target, but growth running in negative territory. We need to look decades back to find something just barely similar. But if we look back towards the 1970s and the 1980s, we actually had quite material volatility in the Fed funds rate through a highly inflationary period. So it is possible to pivot even though inflation is running clearly above target. The latest observation we have was just prior to the big meltdown in 2008. And the Fed actually pivoted ahead of the inflation spiking. So even though inflation may only spike, say, a quarter or two from now, it is possible to pivot before then. I just want to emphasize that. I'm not saying that the pivot is just around the corner. My bet would be that the Fed will pivot around the end of the year because given the change that they made to the way that they look at macro fundamentals back in September 2020, I would argue that they are now more backward looking than prior to COVID. The change they made to target inflation from sort of an average perspective instead of just a nominal perspective made them even more backward looking than they already were. So now they want to see the clear evidence in data that is already past us. They don't want to rely on forecasts, which makes the pivot slower than it would usually have been.
That makes a lot of sense, and you know, you're seeing it reflect in the dollar predominantly. You've got the dollar rallying quite substantially. You've got the euro that succumbed to lows that we haven't seen in I don't know 20 years or something like that. But the euro is breaking down, and I wanted to ask you, how do you feel about the ECB and where they sit? Because a lot of traders and a lot of market players believe that the ECB would have to play some catch up to the Fed, but for obvious reasons, you're seeing the euro break down. It's breaking down against a multitude of currencies. So it seems like the European problem is a little bit bigger than that. What are your thoughts on the eurozone?
I mean, first of all, I'm a happy man these days because I partly make my money in dollars and I pay all of my bills in euros. So happy days right now, right? To get to your question on the European Central Bank, I think they are stuck between a rock and a hard place, basically. And that is the exact reason why the euro is suffering. They want to hike interest rates, that's clear, but they cannot. The reason is that the German economy, the biggest economy in the Eurozone, is already clearly in an industrial recession. And the industry is basically the focal point for the overall economy in Germany. So they are in a big mess, mostly due to the inflation that we've seen in Europe, mostly driven by energy and food, right? Yeah. We are so interlinked with the supply chain in Russia and Ukraine in particular. And that's a bit of a headache for a central bank, because I actually think that the inflation in Europe is mostly supply side driven. I don't think it's the same conclusion in the US. I think it's a lot more demand driven in the US. But when you have mostly supply side inflation, is it then a good idea to hike interest rates or not? Well, I wouldn't be completely certain if I were on the board making such a decision, because essentially, you know, when inflation is driven by supply side issues, that it will sort of take the steam out of the economy by itself to a large extent, which makes it very, very tricky for them to handle this situation. So I think they will slowly but surely dip their toes into hiking territory over the summer here, but I mean, not nearly enough to keep up pace with the Federal Reserve.
All right. Well, that's a really good answer, which suggests, and now I'm going to take it from a trader's point of view. Do you have any downside targets for the euro dollar exchange rate? Do you think we're actually going to slide below parity? And if so, where's your downside target, and where would you actually be a buyer of the euro, if ever? if ever.
That's a tricky question, if ever. But I mean, I've been long the dollar versus the euro for quite a while. People listening to the macro trading for my podcast would know that. And I initially targeted 105 in euro dollar. We are way below that already, right? Yeah. So when we got close to that target, I set a new target of 0.98. So I think we will get below parity. But what I'm watching right now is also the positioning, right? Because it is getting a bit stretched when it comes to the long dollar position versus the euro. Yeah. And I always consider that an early warning signal that the market may be getting a bit too greedy on the trade. So I don't think the trade is exhausted, but I think we've seen the majority of the move already.
That makes a lot of sense from a trader's point of view. Well, let's shift gears over to the BOJ because Japan has been the BOJ and that central bank has been one that's really stood aside, and people expect that the BOJ is going to continue to stand aside. Hence the euro, the dollar yen rallying well above 135 yen. What are your views of the dollar yen, since that was predominantly the driver of dollar strength early on? Before it started bleeding into other major currencies. But how do you feel about the dollar yen where it's currently at, and what the BOJ might do in the future?
I think the biggest issue for the Bank of Japan is a scenario macro-wise where interest rates are going up, because they're stuck with this yield curve control policy where they protect the 10-year point on the yield curve at 10 to 25 basis points, that range. And when interest rates are going up all across the board over the globe, they really struggle to defend that yield curve control, right? They have to print a lot of new Japanese yens to defend it. And that is the exact reason why we've seen an onslaught in the Japanese yen. But if we look a bit ahead, I would actually argue that bond yields have topped now, or peaked already, as a consequence of what we see in the growth cycle. Long bond yields tend to react to the growth cycle before the central bank admits to pausing or even considering pivoting, right? Yeah. And I think we've seen that over the past 3 to 4 weeks, that bond yields have started to react to what's going on in commodity space, what's going on in forward-looking indicators for growth, etc. So it's kind of the savior scenario for the Bank of Japan if global bond yields start to fade again, and that will allow them to print fewer Japanese yens and maybe even start withdrawing yens again if we get a landslide in bond yields during the second half of the year, which I find likely. So to a large extent, I would actually argue that the Japanese yen is a buy now.
Wow. So, and what technical levels have you been looking at, or are you focused on regarding, let's just talk, since we'll just talk the major, the dollar yen pair. Is there any level that you're looking at where you're like, that's it, I need to be long yen below the, as dollar yen below this level?
I mean, it looks kind of peakish if you look at the price action in dollar yen, right? We've been trading between this 35, 36 handle for a few weeks in a row. And that to me is a signal of an exhausted uptrend in the pair. So I took on the trade via a dollar yen put just a few weeks back. So I essentially bought a put down at the 100 level, expecting a big move. So I also bet on higher volatility, right? But I think if the move really gets going, then it will be a quick reversal of what we've seen during the spring.
Wow, that would be something interesting. And the market has again, as traders, being here at Trader Summit, one of the things that we've welcomed so much this year has been this uptick in volatility. But boy, if we saw the dollar yen, pull back towards 120 yen, maybe something like that, that would probably go in line with some of the volatility that we've been seeing across the board, right?
Yeah, definitely. And I mean, typically when the yen rallies, it's because we get a lot of turmoil in other asset classes. So
sure.
I think we need to fasten the seatbelt.
Well, I'm gonna leave it with one last topic, and I want to talk about like U.S. equities, and maybe you can even brush on global equities. But we've seen a pretty staggering pullback since the beginning of the year. Now, minus our keeping in mind that we basically started the year at the highs in the S&P. We're down over 20% in the S&P. How do you feel about global equity markets, where they're at right now, and at what point are they a buy for you?
I mean, I don't consider them cheap yet. Okay. So if you look at price earnings multiples, they look about average. But you need to remember that they are based on forward-looking earnings expectations. And frankly, if you look at earnings expectations still, they are, in my view, completely in la-la land when it comes to earnings for Q3, Q4, and Q1 next year. So what we need to focus on now is the E in the price earnings multiple. We've been looking a lot on multiples through the spring, but from an interest rate perspective, we've seen multiple contraction due to higher interest rates. But what we need to look for now is an earnings recession due to the global recession that I predict. So I'm not a buyer yet, and I want to see the earnings expectations come down before I enter the market again. So I would lean short, and I think the best way to reflect an earnings cycle that is clearly heading downwards is via a short in the Russell index, potentially versus buying Nasdaq if you want to spread trade in equity space.
Wow, that's a great trading idea that we'll leave it at. And I say, Andreas, I love your work as a trader. But if I'm seeing you for the very first time for some odd reason, what's the best way for me to follow you and your work?
I'm on Twitter, at Andreas Steno. And then otherwise, you can look me up on Spotify, Apple Podcast, YouTube, etc. with the podcast, The Macro Trading Flow. We are live on air each Sunday.
I love your podcast. I try to catch it as often as I can, and I want to say thank you for blessing the Trader Summit community with your time today. And if you like what you hear on YouTube, make sure you give us a thumbs up, subscribe to the channel so you don't miss any of our other content. Andrea, thank you for spending your time with us today.
It was a pleasure, Blake. Thank you.
All right. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.